Welcome back to the deep dive. This time we've got something special lined up. It's a personalized deep dive into the world of financial accounting. Just for you. We received a ton of financial statements and accounting guidelines from you, which tells us you're really looking to get a handle on those core concepts. Things like balance sheets, income statements, cash flow statements, and even some of the more complex stuff like partnership accounting and consolidations. So, yeah. You've definitely come to the right place for this.
Absolutely. We've gone through all your materials and really boiled it down to the essentials for you. We'll break down that financial jargon, pull out those key takeaways, and really help you have those aha moments. The ones that turn learning accounting from a chore into something engaging and actually interesting.
So let's kick things off with, the foundational trio of financial statements. We've got the income statement, the balance sheet, and the statement of cash flows.
Yeah.
I mean, you could say they're like the pillars of financial reporting, wouldn't you?
Absolutely. And they work together to tell a comprehensive story about a company's financial performance and position.
So let's start with the income statement. Now, I know it shows a company's financial performance over a specific period, but, is there more to it than just the bottom line net income?
Oh, definitely. The income statement goes beyond just stating that final profit or loss. It breaks down the components of that figure, starting with revenues. That's the money a company brings in from its core business activities. Then you've got expenses, the costs incurred to generate that revenue. It's kind of like a behind-the-scenes look at how that net income number came to be.
So it's like a financial roadmap highlighting the journey from revenue generation to the final profit or loss.
That's a great way to put it. Now, within income statements, you'll come across two main types, single-step and multi-step. The single-step income statement is, as the name suggests, pretty straightforward. It takes all the revenues, lumps them together, then subtracts all the expenses in one fell swoop to get to that net income. It's loved for its simplicity, It avoids any appearance of prioritizing certain revenue or expense items over others.
Simple and straightforward. I like it. But why would a company choose to use a multi-step income statement? It just sounds more complex.
Well, the multi-step statement provides a more detailed view of a company's profitability. It separates operating activities from non-operating activities. So as someone analyzing these statements, you can see how efficiently a company runs its core business before factoring in other financial activities, like investments or one-time gains and losses.
Okay, I see. So if I'm really looking to understand a company's core profitability, the multi-step income statement would be the way to go.
Precisely. One of the key insights a multi-step statement provides is gross profit. It's calculated by subtracting the direct costs of producing goods or services, also known as the cost of goods sold, from revenue. So you can see how much profit a company makes from its core operations before considering things like administrative expenses, marketing costs, or interest payments.
That's really interesting. Now, what about discontinued operations? I remember that being mentioned in the materials.
You're right. Discontinued operations come into play when a company decides to sell off or shut down a whole division of its business. There are specific rules for how this gets reported on the income statement to really make that financial impact clear.
Yeah, wasn't there an example in my materials about like a sports company and their golf division or something?
Yes. Remember All Sports Company? They had a golf division that was consistently losing money, so they made the tough decision to get rid of it. On April 30th of year one, they formally decided to dispose of that golf division. Now, at that point, the division had a carrying value, essentially what's recorded on the books, of $4 million. However, its fair value, what they could realistically sell it for, was only $2.2 million.
So they were going to take a pretty big hit on the sale.
Exactly. That $1.8 million difference is what's called an impairment loss, and it needs to be reported on the income statement as part of discontinued operations. And because that golf division continued to operate until it was finally sold on June 30th of the following year, all the financial activity of that division, both the losses from continued operations and that loss on disposal, are all reported under discontinued operations on the income statement.
It's like giving that struggling golf division its own mini financial statement within the larger company's report. To help outsiders like me really grasp the impact of that decision.
Exactly. That separate reporting for discontinued operations ensures transparency and really helps investors understand the real story behind the numbers.
Okay, I'm with you. So that's the income statement, our first pillar. Now, what about the balance sheet? That one's always seemed kind of static to me, almost like a snapshot in time.
That's actually a great way to think about it. The balance sheet is all about capturing a company's financial position at a specific point in time. It shows what the company owns its assets, what it owes to others its liabilities, and what's left over for the owners the equity.
So it's like a financial selfie showing how a company is dressed financially speaking on a particular day.
Exactly. Now, those assets, liabilities, and equity are the key players here. Assets are resources controlled by the company that are expected to provide some future economic benefits. Think cash buildings, equipment, even intangible things like patents and trademarks.
And liabilities, on the other hand, are the company's obligations to others. These could be loans, unpaid bills, or even future obligations like deferred revenue.
Right. Now, equity represents the owner's stake in the company. It's what's left after all the liabilities are paid off from the company's assets.
I remember this being presented as an equation. Assets equals liabilities plus equity. But honestly, it's kind of hard to visualize what that really means in practice.
Well, visualizing, it's actually quite simple. Just think of the company as a big pie. The assets represent the entire pie. Liabilities are slices of that pie that are owed to others. What's left after those liability slices are accounted for is the equity, the portion of the pie that belongs to the owners.
Okay, that pie analogy actually makes a lot of sense. Now let's move on to the statement of cash flows.
Yeah.
Now, I know it tracked the movement of cash, but how is that different from the income statement, which also deals with money coming in and out?
That's a great question, and it's a common point of confusion. The key difference is timing. The income statement, as we discussed, is prepared using the accrual basis of accounting. This means revenue is recognized when it's earned, and expenses are recognized when they are incurred, regardless of when cash actually changes hands. The statement of cash flows, however, focuses only on the actual cash inflows and outflows that occurred during the period.
So you could have sales recorded on the income statement, even if the customer hasn't actually paid yet.
Precisely. The statement of cash flows cuts through those accruals and deferrals and just shows us the cold, hard cash. It's divided into three main categories: operating activities, investing activities, and financing activities.
Okay, let's break those down a bit.
Yeah.
What kind of cash flows fall under operating activities?
Operating activities encompass the cash flows that are directly related to a company's main business operations, the day-to-day cash transactions that keep the lights on and the business running. It includes the cash coming in from customers' cash, going out to suppliers for inventory cash used for payroll, and even cash paid for things like rent and utilities.
So it's a real-time look at the cash flowing in and out of a company's core operations. What about investing activities?
Investing activities involve the acquisition and disposal of long-term assets, how a company is using its cash for longer-term growth and strategic moves. Imagine a company buying a new factory or piece of equipment. That would be a cash outflow under investing activities.
And if they sold an old piece of equipment, that would be a cash inflow under investing activities.
Exactly. Investing activities also include buying and selling investments in other companies. It's all about how a company is managing its long-term assets to potentially grow and generate future profits.
And what about financing activities? I feel like that one could get pretty interesting.
Financing activities tell the story of how a company is raising and repaying capital. It shows you where the money is coming from to fund the company's operations and investments.
So if a company issues stock or bonds to raise money, that would be a cash inflow under financing activities.
Exactly. And if they pay dividends to shareholders, that would be a cash outflow. The same goes for repurchasing stock or repaying debt. Financing activities give you a glimpse into a company's capital structure and how they're managing their financial obligations.
Okay, this statement of cash flows really provides a different perspective than the income statement, even though they're both focused on money coming in and out.
Exactly. Now let's move on to one final concept in our financial statement: fundamentals. Comprehensive income. You can think of this as an expanded view of a company's financial performance that goes beyond that traditional net income figure.
So it's like looking at the full picture of a company's financial performance, not just the highlights.
Precisely. Comprehensive income captures certain gains and losses that aren't reflected in net income, but are still important for understanding a company's overall financial health. This often includes unrealized gains or losses, meaning gains or losses on certain investments that haven't yet been sold.
Wasn't there an example in my materials? Something about Sydney Technologies?
Yes. Let's say Sydney Technologies owns some investments that have gone up in value during the year, but they haven't sold them yet. Those unrealized gains wouldn't be included in their net income, but they would be reported on a separate statement called the Statement of Comprehensive Income. This statement captures those unrealized gains, giving you a more complete picture of their financial performance, including both realized and unrealized items.
It's like acknowledging that those investments, even though they haven't been sold, have still contributed to the company's overall financial position.
Exactly. And along with unrealized gains and losses, the statement of comprehensive income also includes things like foreign currency translation adjustments and certain pension adjustments. It provides a more holistic view of a company's financial performance, considering all those items that wouldn't fit neatly on the traditional income statement.
Okay, so we've covered the income statement, the balance sheet, and the statement of cash flows, the foundation of financial reporting. Now let's move on to some of the key accounting concepts that help us understand the numbers behind those statements.
Absolutely. There are a few key concepts you need to grasp to really decipher those financial statements. One of the most important is revenue recognition.
Revenue recognition is all about when a company can actually record revenue on its income statement, right? I know there are rules to prevent companies from cooking the books.
That's right. Revenue is the lifeblood of any business, and the revenue recognition principle aims to prevent companies from prematurely or inaccurately inflating their revenue figures. It ensures that revenue is recognized when it's earned, meaning when the company has fulfilled its performance obligations to the customer.
So it's not just about receiving cash, it's about actually delivering those goods or services.
Precisely. And to add structure to this process, U.S. GAAP lays out a 5-step process to ensure proper revenue recognition.
5 steps. That sounds a bit daunting.
Don't worry, it's more logical than it might seem. It all starts with identifying the contract with the customer. Then you identify the performance obligations outlined in that contract, what distinct goods or services the company has promised to deliver.
So if a company is selling a package deal, you have to break down the value of each separate item or service within that package.
Exactly. The third step is to determine the transaction price, what the customer will pay in total for those goods or services. Once you have that, you allocate the transaction price to each separate performance obligation, essentially figuring out how much revenue should be recognized for each item in the deal.
And finally, you recognize revenue as the company satisfies each of those performance obligations. So if the performance obligation is fulfilled over time, revenue is recognized gradually as the work is done, and if it's fulfilled at a point in time, all the revenue is recognized at once.
You nailed it. Now let's make this a bit more concrete. Remember Tanner Co. from your materials? They're building a multi-unit residential complex.
Yes, I remember that example. They entered into a contract with a customer for a specific unit that was still under construction.
Right. And the contract included details like a non-refundable deposit, upfront progress payments during construction, and stipulations about payment, and the inability to redirect the unit to another customer. These details are important for determining how that revenue should be recognized.
So how did those contract details impact revenue recognition for Tanner Co.?
Well, because Tanner Co. is continuously fulfilling its performance obligations by constructing the unit over time, this would be considered a performance obligation satisfied over time. Therefore, they would recognize revenue gradually as construction progresses, rather than all at once when the unit is completed.
Okay, that makes sense. The revenue recognition process, while detailed, ensures that companies are accurately reflecting their earnings and prevents them from prematurely booking revenue before the work is done.
Exactly. Now let's shift gears to another important concept: accounting changes and error corrections.
This is about what happens when a company needs to change an accounting method or discovers a mistake in their books. These things happen, right?
They do. And there are specific rules to ensure that those changes and corrections are handled consistently and transparently. Let's start with accounting changes. There are different types of accounting changes, such as changes in accounting principle, changes in estimate, and changes in reporting entity. Changes in accounting principle occur when a company adopts a different acceptable method of accounting for a particular item.
My materials highlighted a change in depreciation method as an example. I think it was Jordan Manufacturing.
Yes. Let's say Jordan Manufacturing discovers their depreciation expense was miscalculated in prior years. Instead of going back and fixing every past financial statement, they would adjust the beginning balance of retained earnings to reflect the corrected depreciation.
So it's like cleaning up the starting point to ensure the current and future financials are accurate without rewriting history.
Precisely. Now let's say Jordan Manufacturing also decides to change their inventory cost flow assumption from LIFO, last in, first out, to FIFO, first in, first out. This is a change in accounting principle, and in this case, it does require retrospective application, meaning they need to go back and restate those prior year's financial statements as if they had always been using FIFO.
I can see how that ensures comparability over time. It's like comparing apples to apples even though they've switched accounting methods?
Exactly. Now, the rules for error corrections are similar. Errors discovered in the current period are corrected with a journal entry. However, errors from prior periods, just like some changes in accounting principle, typically require an adjustment to the beginning balance of retained earnings net of any tax effects.
So error corrections and accounting changes ensure that the financial statements are a reliable representation of the company's financial performance and position, even if adjustments need to be made.
Exactly. Now let's move on to foreign currency translation, which comes into play when companies engage in international business.
Dealing with different currencies has always seemed complex to me. It's like adding another layer of complexity to the already complex world of accounting.
It definitely adds a new dimension. Let's say a U.S. company makes a sale to a customer in Europe, and the payment is agreed upon in euros. The company needs to record that transaction in U.S. dollars for its financial statements. But as you know, exchange rates fluctuate constantly.
So how do they determine what exchange rate to use? It seems like a moving target.
Well, at the initial transaction date, they would use the current exchange rate to record the sale. However, what happens if that exchange rate changes between the date of the sale and the date the customer actually pays? That's where foreign exchange gains and losses come in.
So if the euro strengthens against the dollar between the sale date and the payment date, the U.S. company would end up receiving more dollars than they initially anticipated, resulting in a foreign exchange gain.
Exactly. And if the euro weakens, they'll have a foreign exchange loss. These gains and losses are reported on the income statement.
It seems like foreign currency transactions add an element of risk and reward for companies doing business internationally. But at least those fluctuations are accounted for and reported transparently in the financial statements.
Absolutely. And this highlights the importance of carefully managing foreign currency exposure to mitigate those potential losses. There are various strategies and hedging techniques that companies can use to protect themselves from those currency fluctuations.
Okay, now let's move on to a topic I've always found intriguing. Stockholders' equity. It's essentially the owner's claim on the company's assets. But it's subdivided into various components, isn't it?
You're right. Stockholders' equity is like a pie chart that breaks down the ownership structure of a company. It includes common stock, preferred stock, additional paid-in capital retained earnings, and sometimes treasury stock.
Can you break down those components a bit further?
Of course. Common stock represents the basic ownership shares of a company. It's what most people think of when they hear the word stock. Preferred stock, on the other hand, comes with special privileges compared to common stock, often including priority in receiving dividends.
What about additional paid-in capital? I remember that one being a bit confusing.
Additional paid-in capital is essentially the amount investors pay for stock that is above its par value. Par value is a nominal amount assigned to a share of stock, often very low, like 0 to 1 cents per share. It's mainly a legal concept and doesn't really reflect the market value of the stock.
So if a company issues stock for $10 per share and the par value is only $0.01, most of that $10 goes into additional paid-in capital.
Exactly. It represents the premium investors are willing to pay above that tiny par value, reflecting their confidence in the company's future prospects.
What about retained earnings?
Yeah.
That's the portion of a company's profits that they've held on to over time, right?
That's right. Retained earnings represent the cumulative earnings of the company that have been reinvested back into the business instead of being distributed as dividends. It's a measure of the company's profitability over its lifetime.
And finally, we have treasury stock. What exactly is that?
Treasury stock is a company's own stock that they've repurchased from the market. It's essentially a reduction in stockholders' equity because those shares are no longer outstanding.
So it's like the company's buying back pieces of itself. What's the purpose of that?
There are various reasons why companies might repurchase their own stock. It could be to increase the value of the remaining shares, signal confidence in their future prospects, or even just to have shares available for employee stock option plans.
So stockholders' equity is like this dynamic puzzle, constantly changing, as companies issue stock, repurchase stock, generate profits, and distribute dividends. It's a key indicator of a company's financial structure and ownership.
Absolutely. Now, speaking of distributing profits, let's talk about dividends.
Dividends are a way for companies to share their profits with their shareholders, right? It's like a reward for investing in the company.
You've got it. And there are different types of dividends, including cash dividends, stock dividends, and even something called liquidating dividends.
Cash dividends are the most common, right? That's where companies literally pay out cash to their shareholders.
Exactly. It's like getting a paycheck from your investment. Stock dividends, on the other hand, involve issuing additional shares of stock to existing shareholders. It's like getting more ownership in the company instead of cash.
What about liquidating dividends? Those sound a bit ominous.
Liquidating dividends are a bit different. They're distributions that exceed the company's retained earnings, often paid out when a company is in the process of liquidating or significantly downsizing its operations.
So it's like a partial return of capital when the company is winding down or restructuring?
Exactly. And it's important to note that the decision to pay dividends and the form those dividends take is entirely up to the company's board of directors. They consider factors like the company's profitability, future investment needs, and the overall financial health of the company.
That makes sense. Now let's move on to a business structure that I've always found intriguing. Partnerships.
Partnerships involve two or more individuals joining forces to own and operate a business. It's a popular structure, especially for smaller businesses or professional practices.
Partnership accounting seems like it could get pretty complex, especially when it comes to allocating those profits and losses among the partners.
It definitely has its nuances. Partnership accounting covers everything from the initial formation of the partnership to the admission and withdrawal of partners and even the eventual liquidation of the partnership. It involves tracking each partner's capital account, which reflects their ownership interest in the partnership, and allocating profits and losses according to the partnership agreement.
So the partnership agreement is like a financial roadmap for the partners outlining how they will share the rewards and the risks of the business.
Exactly. And one of the interesting aspects of partnership accounting is how we deal with the admission of new partners. There are two main methods used to allocate partnership interests when a new partner joins: the bonus method and the goodwill method.
Could you explain those methods a bit further?
Of course. The bonus method, as its name implies, involves a bonus being paid either to the new partner or to the existing partners. This depends on whether the new partner's investment is more or less than the book value of their ownership interest.
So if a new partner invests $100,000 for a 25% interest, but the book value of that interest is only $80,000, the existing partners would essentially be giving the new partner a $20,000 bonus.
You got it. And that bonus would be allocated among the existing partners based on their profit-sharing ratios. Conversely, if that same new partner invested $100,000 for a 25% interest, but the book value of that 25% interest was $120,000, the new partner would effectively be paying a bonus to the existing partners, reducing their capital accounts.
It's like a balancing act to ensure the new partner's contribution aligns with their ownership stake.
Exactly. Now, the goodwill method is a bit different. It involves recognizing goodwill, which is an intangible asset representing the value of a company's reputation, brand recognition, customer relationships, and other non-physical assets.
So if a new partner is bringing something valuable to the table beyond their tangible investment, the goodwill method would be used to capture that value.
Precisely. When a new partner joins the partnership, might determine that the total value of the partnership is higher than the sum of its identifiable net assets, things like cash, inventory, and equipment. That difference, which essentially represents the premium being paid for those intangible assets, is recognized as goodwill.
And that goodwill is then allocated to all the partners based on their profit and loss sharing ratios.
Exactly. The goodwill method captures the intangible value that a new partner brings to the partnership, recognizing that a company's worth often extends beyond its tangible assets.
That's a fascinating insight into partnership dynamics. Okay, now let's move on to our final advanced topic for this deep dive: consolidations.
Consolidations come into play when a parent company has a controlling interest in one or more subsidiaries, meaning they own more than 50% of the voting stock. In these cases, they're required to prepare consolidated financial statements, which combine the financial information of the parent company and all its subsidiaries to one comprehensive report.
So it's like creating a mega corporation from all those separate pieces.
That's a great way to put it. Now, one crucial aspect of consolidations is eliminating intercompany transactions. Remember, those are transactions that happen between the parent company and its subsidiaries. We need to eliminate them to avoid double counting and to ensure we're presenting an accurate view of the consolidated entity's performance.
Can you give an example of an intercompany transaction and why it needs to be eliminated?
Absolutely. Imagine Gertie Tools, a parent company, sells inventory to its subsidiary Alintocor at a 10% markup. On Gertie Tools' individual financial statements, that markup would be recorded as profit. However, from a consolidated perspective, it's not a true profit because it's essentially a transfer of goods within the same economic entity.
It's like moving money from one pocket to another.
Precisely. So during the consolidation process, that 10% markup would be eliminated to avoid inflating the consolidated entity's overall profits.
Consolidations seem complex, but I understand why they're necessary. It's about presenting a unified view of the entire economic entity controlled by that parent company.
You've got it. We want to ensure that investors and other stakeholders are seeing the true financial picture of the entire group, not just the individual pieces.
Okay, so we've covered the foundational financial statements, the income statement, the balance sheet, and the statement of cash flows. And we've touched upon some key accounting concepts like revenue recognition, accounting changes, foreign currency transactions, stockholders' equity partnerships, and even consolidations.
And we're just getting started. There's a lot more to explore in the world of financial accounting. But this deep dive has given you a solid foundation to build upon as you continue to explore those financial statements and accounting concepts.
Okay, so we've explored those foundational financial statements and tackled some core accounting concepts.
Now let's shift gears and zoom in on some of the intricate details of specific transactions and accounting treatments.
Sounds good to me. Where do we start?
Let's start with something you'll find on most balance sheets: stock transactions. Remember those components of stockholders' equity we talked about? Well, each stock transaction impacts those accounts in a unique way.
It's like a delicate dance between common stock, additional paid-in capital, and retained earnings.
Precisely. Let's illustrate this with a simple example, using the par value method. Imagine a company issues 10,000 shares of common stock with a par value of $10 per share, and they manage to sell all those shares for $15 each. The accounting entry would look like this. We debit cash for $150,000. That's the total cash received. Then we credit common stock for $100,000, 10,000 shares times the $10 par value. And finally, we credit additional paid-in capital for the remaining $50,000.
So the par value goes to the common stock account, and any excess what investors paid above that par value goes to additional paid-in capital.
Exactly. It's a clear way to track where that equity funding is coming from. Now, let's say the company decides to buy back some of its own shares, maybe as part of a strategy to boost the value of the remaining shares. They repurchase 200 shares for $20 per share. This gets recorded as a debit to treasury stock for $4,000. 200 are as times the $20 repurchase price.
And what account gets the credit? I'm guessing it depends on how they account for treasury stock.
You're right. There are a couple of methods, and the most common is the cost method. With this method, the credit would go to cash for the $4,000 they used to buy those shares back. But there's another method called the par value method. If they use that, the credit would be split between common stock for $2,000, $200 times the $10 par value, and additional paid-in capital for the remaining $2,000.
So the par value method keeps a closer connection to the original issuance details, while the cost method is simpler.
That's a good way to summarize it. Now let's move on to another scenario you might encounter: stock subscriptions. This is when investors agree to purchase stock in the future, often making payments in installments.
It's kind of like pre-ordering stock, right? You're committing to buy it, but you're paying for it gradually.
Precisely. When a company receives a stock subscription, they record a debit to subscriptions receivable for the total amount the investor has agreed to pay. Then they credit common stock subscribed for the par value of those shares and additional paid-in capital for any excess above par. As the investor makes payments, the subscription's receivable account goes down and cash goes up.
So it's like slowly converting that promise to pay into actual stock ownership.
Exactly. Now let's revisit retained earnings, that crucial component of stockholders' equity. It's not a static number. It's impacted by various transactions, including net income dividends and even corrections from prior periods or changes in accounting methods.
Yeah, I know net income increases retained earnings and dividends decrease them. But what about those other adjustments you mentioned?
Well, sometimes companies need to correct errors made in prior financial statements. These corrections are called prior period adjustments. They bypass the current income statement and are directly reflected in retained earnings.
So it's like cleaning up the past to ensure the current and future numbers are accurate?
Exactly. And remember those accounting changes we discussed earlier? Well, sometimes those changes require adjustments to retained earnings, especially if they involve restating prior year's financials. It's all about making sure the numbers are consistent and comparable over time.
Okay, I see how retained earnings is like a running tally of a company's earnings history, adjusted for those corrections and changes in accounting methods. It tells a more complete story about the company's profitability over time.
Precisely. Now let's dive back into revenue recognition. But this time, let's explore some more complex scenarios that you might come across in those financial statements.
Sounds good. What are we unpacking this time?
This time we're looking at situations where a company has fulfilled its performance obligations, earned the revenue, but can't actually bill the customer for it yet.
So they've earned it, but they can't collect it. Why would that happen?
Well, imagine a scenario where a company delivers a product, but the customer doesn't have to pay until they achieve certain milestones, or the company completes some additional performance obligations.
Ah, so it's like a conditional sale.
Mhm.
The revenue is earned, but not yet fully billable.
Exactly. In these situations, U.S. GAAP says the company would recognize a contract asset. It's essentially a right to consideration in the future. Once those conditions are met and the right to bill the customer becomes unconditional, the company can convert that contract asset into a receivable.
Okay, that makes sense. It's like a waiting room for revenue.
Yeah.
Now, what about those accounting changes and error corrections? Can we dive a bit deeper into those?
Absolutely. Remember, we talked about the different types of accounting changes. Changes in accounting principle, changes in estimate, and changes in reporting entity. Each type has specific rules for how it's reflected in the financial statements.
The ones that often require retrospective application are changes in accounting principle, right?
That's right. If a company switches from one acceptable accounting method to another, like changing from LIFO to FIFO for inventory valuation, they might need to go back and restate prior year's financials to make them comparable. It's like rewriting history to show what the numbers would have looked like if the new method had always been used.
That makes sense. But wasn't there an exception to that?
You're right. Changes in depreciation method are a bit different. Instead of restating prior years, a change in depreciation method is treated prospectively, meaning it only affects the current and future periods.
So no need to go back and rewrite history when a company changes how it depreciates its assets.
Exactly. Now, changes in estimate are also treated prospectively. These are changes that arise from new information or better estimates, like revising the useful life or salvage value of an asset.
Okay, so both changes in depreciation method and changes in estimate are handled prospectively. What about changes in reporting entity? Those sound more complex.
Changes in reporting entity happen when the structure of the entity being reported on changes. For example, if a company starts consolidating a subsidiary that wasn't previously consolidated, or if a company divests a segment, those are changes in reporting entity.
And those usually require retrospective application, right?
You got it. It's about making sure the financials consistently reflect the composition of the entity being reported on.
Now, what about error corrections? Those are just plain old mistakes in the books, right?
That's right. And how they're handled depends on when those mistakes are discovered. If an error is caught in the current period, it's corrected through a simple journal entry. But errors from prior periods usually require a more complex adjustment to the beginning balance of retained earnings, making sure the current year's income statement isn't carrying the weight of past mistakes.
It's like cleaning up the starting line to ensure a fair race.
That's a great analogy. Now let's take a step back from the numbers themselves and explore the notes to the financial statements. They might seem like an afterthought, but they actually provide crucial context and insights that go beyond those raw numbers in the main statements.
I've always thought of the notes as being kind of like the fine print. You know, it's important, but you don't always want to read it.
I understand that feeling. But in accounting, those notes are essential reading. They provide the background information and additional details that really help you understand the company's financial health and performance.
So what kind of information is typically found in the notes?
The notes can contain a wealth of information. For example, you'll find details about the company's significant accounting policies. It's like a peek behind the curtain to see how they make those judgments and estimates that impact the numbers.
That makes sense. And I'm guessing they also disclose any significant accounting estimates they've made.
Absolutely. Things like the useful life of an asset, the allowance for doubtful accounts, or even the valuation of complex financial instruments. These estimates require judgment, and the notes provide transparency into how the company arrived at those figures.
The notes also cover contingencies, right? Those potential future obligations that depend on uncertain events.
Exactly. Remember, contingencies are those maybe liabilities like pending lawsuits or product warranties. The notes will provide details about the nature of those contingencies, the estimated likelihood of them becoming actual liabilities, and any potential financial impact.
So even though contingencies aren't guaranteed liabilities, they can still pose a potential risk to a company's financial health, and the notes help us assess that risk.
Precisely. The notes can also disclose commitments the company has made, even if they haven't yet impacted the financial statements. This could be things like long-term lease agreements, purchase agreements, or even employment contracts.
So the notes provide a glimpse into the future, highlighting potential obligations or commitments that could affect the company's financial position down the road.
You got it. They also disclose events that happen after the balance sheet date, but before the financial statements are issued. We call these subsequent events.
Subsequent events.
Yeah.
So something significant happens after the reporting period is ended, but before the statements are finalized.
Exactly. And these events can be categorized as either recognized or non-recognized. Recognized subsequent events provide evidence about conditions that already existed at the balance sheet date, while non-recognized subsequent events are new things that happened after the reporting period.
I'm guessing recognized subsequent events require adjustments to the financial statement.
You're right. If a customer goes bankrupt after the balance sheet date, but they were already showing signs of financial trouble before the balance sheet date, that bankruptcy is considered a recognized subsequent event, and it would require an adjustment to the allowance for doubtful accounts.
It's like confirming something that was already brewing.
Exactly. Non-recognized subsequent events, on the other hand, usually don't require adjustments to the financial statements.
So if a company has a fire after the balance sheet date, they wouldn't need to adjust their financials for that.
Not necessarily. However, if that fire is material, meaning it could significantly impact investors' decisions, the company would need to disclose it in the notes to the financial statements.
So the notes of the financial statements really are like a treasure trove of information, providing context, insights, and disclosures that go beyond the numbers in the main statements.
Absolutely. And they're crucial for getting a complete picture of a company's financial health and performance.
Okay, now let's dive into a concept that seems straightforward, but can be quite nuanced. Fair value. I know it's the price that would be received to sell an asset or paid to transfer a liability, but how is it actually determined?
You're right. Fair value is a market-based measurement, not specific to the company holding the asset or liability. It's essentially the price that would be agreed upon between knowledgeable and willing parties in an arm's-length transaction.
So it's not about what the company paid for the asset originally or what it means to them personally. It's about what the market dictates.
Precisely. It's an exit price focusing on the price received for selling the asset or paid to transfer the liability. And thankfully, U.S. GAAP provides a structured framework for measuring fair value. It uses a hierarchy of inputs that can be plugged into valuation techniques.
A hierarchy of inputs sounds intriguing.
It's all about reliability. The most reliable inputs are level 1 inputs, which are based on quoted prices in active markets for identical assets or liabilities. Think of publicly traded stocks. Their fair value is readily observable based on their current market price.
So if a company holds shares of Apple stock, determining their fair value is as easy as checking the stock ticker.
Exactly. But what about assets that aren't traded on active markets? That's where level 2 and level 3 inputs come in.
Okay, tell me more about those.
Level 2 inputs are less reliable than level 1 inputs because they rely on observable market data for similar assets or liabilities. For example, if a company owns a building, they might use recent sales data for comparable buildings in the same area to determine its fair value.
So it's like using market data as a benchmark, even if it's not for an identical asset.
Precisely. And then we have level 3 inputs, which are the least reliable because they're based on unobservable inputs, things like the company's own assumptions or forecasts.
So level 3 inputs are more subjective, relying on the company's own judgment and estimate.
Exactly. The fair value hierarchy is all about transparency and reliability, prioritizing observable market data whenever possible.
That makes sense. Now let's step outside the realm of traditional GAAP and explore something called special purpose frameworks. What exactly are those?
Special purpose frameworks are accounting frameworks that deviate from traditional U.S. GAAP. They're often used by non-public companies that don't need to follow GAAP, or by companies reporting on specific transactions or activities that are better suited to a different framework.
So like having different sets of accounting rules for different situations.
Precisely. One common example is the cash basis of accounting. It's much simpler than accrual basis accounting and is often used by small businesses or individuals.
Cash basis is all about recognizing revenue when cash is received and expenses when cash is paid right. No complex accruals or deferrals.
Exactly. It's straightforward and focuses on the actual flow of cash. There's also the modified cash basis, which is a hybrid approach that combines elements of both cash basis and accrual basis accounting.
So it's like a middle ground between the simplicity of cash basis and the more comprehensive accrual basis.
Precisely. And there are other special purpose frameworks out there, each with its own unique purpose and set of rules. For example, there's the tax basis of accounting, which is used specifically for tax reporting purposes. And then there are price-level adjusted financial statements, which attempt to account for the effects of inflation, providing a more realistic picture of a company's financial performance in an inflationary environment.
So it's like having a toolbox of different accounting frameworks, each designed for a specific purpose.
That's a great way to put it. Now let's shift our focus from specific accounting frameworks to a powerful tool used for analyzing a company's performance: ratio analysis.
Ratios are like financial health indicators, right? They help us assess a company's profit, liquidity, solvency, and overall financial performance.
Exactly. Ratios provide a standardized way to analyze financial data, making it easier to compare a company's performance to its own past performance, to industry benchmarks, or even to its competitors.
Let's dive into some specific ratio categories. I'm particularly interested in profitability ratios, as those seem like the most fundamental indicators of a company's success.
You're right, profitability ratios are crucial for understanding a company's ability to generate profits from its operations. Some of the key profitability ratios include gross profit margin, return on sales, return on assets, and the DuPont return on assets.
Could you break those down a bit further? What are their unique insights?
Of course. Gross profit margin measures the profitability of a company's core operations. It tells you how much profit is left over from revenue after deducting the direct costs of producing those goods or services.
So a higher gross profit margin generally indicates better cost control and efficiency in the core business operations.
Exactly. Profit margin, on the other hand, looks at profitability from a broader perspective. It considers all expenses, not just the direct costs of production. It tells you how much profit is left over from each dollar of revenue after all expenses have been paid.
So a higher profit margin indicates a company's overall efficiency in managing its expenses and generating profits.
Precisely. Now, return on sales and return on assets are efficiency ratios. Return on sales measures how efficiently a company is using its sales to generate profits, while return on assets looks at how effectively they're deploying their assets to generate profits.
And the DuPont return on assets takes an even deeper dive.
Yes. The DuPont analysis breaks down return on assets into two components: profit margin and asset turnover. Asset turnover tells you how efficiently a company is using its assets to generate sales.
So a company with a low profit margin could still achieve a decent return on assets if they have a very high asset turnover. Yeah. It's about finding ways to efficiently utilize those assets to drive sales.
That's a great observation. Now, moving on from profitability, let's talk about liquidity ratios. These are all about a company's ability to meet its short-term obligations using its most liquid assets.
It's about having enough cash on hand to pay the bills as they come due.
Exactly. Key liquidity ratios include the current ratio and the quick ratio. The current ratio compares a company's current assets, things like cash accounts receivable and inventory, to its current liabilities obligations due within 1 year.
So a current ratio of 2.1 would mean that a company has twice as many current assets as current liabilities, indicating a good cushion for meeting those short-term obligations.
Precisely. The quick ratio, also known as the acid test ratio, is a more stringent measure of liquidity. It excludes inventory from current assets, focusing on those assets that can be most quickly converted to cash.
So the quick ratio is like a worst-case scenario measure, assuming the company might have trouble selling its inventory quickly.
You got it. Now, shifting from short-term obligations to long-term financial stability, let's talk about solvency ratios. These ratios assess a company's ability to meet its long-term debt obligations.
Solvency is all about a company's ability to stay afloat in the long run, making sure they can manage their debt and avoid financial distress.
Exactly. Key solvency ratios include the debt-to-equity ratio, the debt-to-asset ratio, also known as simply the debt ratio, and the times interest earned ratio.
Could you explain those ratios a bit further? I'm particularly interested in how they reflect a company's debt levels.
Of course. The debt-to-equity ratio compares a company's total debt to its shareholders' equity. It essentially tells you how much of the company's financing is coming from debt versus equity.
So a higher debt-to-equity ratio means the company is using more debt financing, which could be riskier if they can't generate enough earnings to cover those debt payments.
Exactly. The debt-to-asset ratio is similar, but it compares total debt to total assets. It provides another perspective on the proportion of the company's assets that are financed with debt.
Okay, so both the debt-to-equity ratio and the debt-to-asset ratio provide insights into a company's capital structure and the extent to which they're relying on debt financing. What about the times interest earned ratio?
The times interest earned ratio measures a company's ability to cover its interest expense with its earnings. It's calculated by dividing earnings before interest and taxes, or EBIT, by interest expense.
So a higher times interest earned ratio indicates that a company can more comfortably cover its interest payments, reducing the risk of default.
Precisely. It shows how much breathing room they have when it comes to meeting those interest obligations.
These solvency ratios are really important for assessing a company's long-term financial stability and their ability to manage their debt load. Now, can we talk about performance metrics? I know investors often look at these to evaluate a company's attractiveness and potential.
Absolutely. Performance metrics provide a standardized way to assess a company's operating performance and even its stock valuation. One commonly used metric is EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization.
So EBITDA is like a stripped-down measure of a company's core profitability, ignoring those non-cash expenses like depreciation and amortization.
Exactly. It helps investors focus on the company's operating performance before considering the impact of financing and accounting decisions. Another widely used metric is earnings per share, or EPS. It measures the portion of a company's profits that are allocated to each outstanding share of common stock.
EPS is a key indicator of a company's profitability from a shareholder's perspective, showing how much of the earnings pie each share is entitled to.
Precisely. And it's often used to compare the profitability of different companies or to track a company's earnings growth over time. Now, what about the price to earnings ratio, or PE ratio? That one comes up frequently in stock analysis.
Yes, the PE ratio is a valuation metric that compares a company's stock price to its earnings per share. It basically tells you how much investors are willing to pay for each dollar of earnings.
Exactly. A higher PE ratio often indicates that investors are more optimistic about a company's future growth prospects, while a lower PE ratio might suggest they're more cautious.
It's interesting to see how these different performance metrics can shed light on a company's financial performance, profitability, and even market valuation.
You got it. Now let's shift our focus to another important area: variance analysis. This is all about understanding the differences between planned and actual results, helping companies identify areas where they've performed better or worse than expected.
I've always thought of variance analysis as being kind of like detective work, digging into those budget variances and figuring out why they happened.
That's a great way to put it. Variance analysis is a powerful tool for performance management and decision-making, helping companies identify areas for improvement or opportunities to capitalize on successes.
One common approach to variance analysis is flexible budgeting. It adjusts the original budget to reflect the actual level of activity, making it easier to isolate the impact of changes in volume on revenues and costs.
Exactly. Flexible budgeting separates the impact of volume changes from other factors that can affect performance, such as price changes, cost efficiencies, or even changes in the mix of products or services sold.
So if a company sells more units than they initially budgeted for a flexible budget, would adjust the revenue and cost figures to reflect that higher volume, allowing for a more accurate assessment of their performance.
Precisely. It provides a clearer picture of how well a company is controlling costs and managing its operations, even when those volumes fluctuate.
Flexible budgeting is a powerful tool for variance analysis, providing insights into operational efficiency and cost control. Now let's shift our focus to an important aspect of internal control: bank reconciliations.
Bank reconciliations are a fundamental internal control procedure that helps companies ensure the accuracy and completeness of their cash records. They involve comparing the company's cash balance according to their books to the bank's balance according to the bank statement and identifying any discrepancies.
It's like a double-check system to catch any errors or even potential fraud.
Exactly. Bank reconciliations help protect a company's most liquid asset, cash, by identifying and resolving timing differences and errors that can arise from the natural flow of transactions.
What are some common timing differences that companies need to reconcile?
One common timing difference is deposits in transit. These are deposits that the company has recorded in their books but that haven't yet been processed by the bank. Conversely, outstanding checks are checks that the company has written and recorded but that haven't yet been presented to the bank for payment.
So deposits in transit would increase the bank balance on the reconciliation, while outstanding checks would decrease it.
You've got it. Other common reconciling items include bank errors, such as incorrectly recording a deposit or a check, and non-sufficient funds, or NSF checks, which are checks that bounce because the payer doesn't have enough money in their account.
So a bank reconciliation involves identifying all those reconciling items, adjusting the book balance or the bank balance as needed, and making sure everything ties out. It's like solving a financial puzzle.
That's a great way to think about it.
Yeah.
And a properly conducted bank reconciliation helps ensure that a company's cash records are accurate and reliable.
Okay, now let's move on to another important asset: accounts receivable. These are the amounts owed to a company by its customers for goods or services that have been delivered but not yet paid for.
Accounts receivable represent a promise of future cash inflow, but they also carry a degree of risk. Not all customers pay their bills on time, and some might not pay at all.
That's why companies need to carefully manage their accounts receivable and make sure they're collecting those payments in a timely manner.
Exactly. Effective accounts receivable management is crucial for maintaining a healthy cash flow. Companies need to strike a balance between extending credit to customers to boost sales and minimizing the risk of non-payment.
One important aspect of accounts receivable management is estimating the allowance for doubtful accounts. This is the amount the company anticipates not being able to collect.
Precisely. The allowance for doubtful accounts is a contra-asset account, meaning it reduces the value of accounts receivable on the balance sheet to reflect the estimated portion that will ultimately be uncollectible.
There are a couple of methods for estimating the allowance rate: the percentage of sales method and the aging of receivables method.
You're right. The percentage of sales method is a simple approach that applies a historical percentage of bad debts to current sales. The aging of receivables method, on the other hand, categorizes receivables by their age, recognizing that older receivables are more likely to become uncollectible.
So if a company has a lot of old outstanding invoices, their allowance for doubtful accounts would likely be higher.
Exactly. The aging of receivables method is generally considered more accurate because it considers the specific characteristics of the outstanding receivables.
Another interesting aspect of accounts receivable is factoring right.
Yes, factoring is when a company sells its accounts receivable to a third party called a factor to receive cash more quickly. It can be a useful tool for companies with cash flow issues, but it comes at a cost.
So the company gets cash up front, but they typically have to pay a fee to the factor and might not receive the full value of those receivables.
Exactly. It's a trade-off between speed and cost. Now let's talk about a similar but slightly different asset, notes receivable.
Notes receivable are also promises to pay, but they're more formal than accounts receivable, right?
You got it. Notes receivable are formal written promises to pay a specific amount at a specific future date, usually with interest. They often arise from lending money, extending credit for a large purchase, or even converting an overdue account receivable into a note to formalize the repayment terms.
And notes receivable, just like accounts receivable, can be sold to a third party, right? That's called discounting.
That's right. Discounting a note receivable involves calculating the present value of the future cash flows using an appropriate discount rate. The difference between the face value of the note and its present value is the discount.
So the buyer of the note is essentially paying a reduced price today in exchange for receiving those future cash flows.
Precisely. Now let's shift our focus to another crucial asset for companies that sell goods: inventory.
Inventory is a company's lifeblood right. It's the goods they hold for sale, representing a significant portion of their assets.
Exactly. Proper inventory management is crucial for ensuring a company has enough goods on hand to meet customer demand without tying up excessive capital in unsold inventory. And a key aspect of inventory accounting is determining the cost of goods sold, or COGS.
COGS represents the cost of the inventory that's been sold during a period, right? I know it's a major expense in the income statement and has a direct impact on a company's profitability.
You're right. And there are various methods for calculating COGS depending on the inventory cost flow assumption used. We discussed LIFO and FIFO earlier, but there's also the weighted average method, which blends the cost of different inventory purchases to determine an average cost per unit.
So the choice of inventory cost flow assumption can impact a company's reported profits.
Absolutely. Now, another important concept in inventory accounting is the lower of cost, or market rule, or LCM. This rule ensures that inventory is not overstated on the balance sheet.
So if the market value of inventory declines below its original cost, the company has to write down the inventory to that lower market value.
Precisely. It's all about reflecting the most conservative and realistic value of inventory on the balance sheet. Now, let's look at some specific situations that can impact inventory accounting. For example, have you heard of consignment goods?
Consignment goods, those are goods held by one party for sale on behalf of another party, right?
Exactly. The party holding the goods, the consignee, doesn't actually own them. The consignor, the original owner, retains ownership until those goods are sold. So even though the consignee is physically holding the goods, they're not included in their inventory. They remain on the consignor's balance sheet.
It's like outsourcing the sales process without transferring ownership.
That's a great analogy. Another interesting scenario is sales with a mandatory buyback. Sometimes a company might sell goods with an agreement to repurchase them at a later date. If that repurchase obligation is unavoidable, the goods are kept on the seller's balance sheet even though they've technically been sold.
It's like a temporary sale with a guaranteed return.
Exactly. Now let's move on from inventory to another major category of assets: property, plant, and equipment, or PP&E.
PP&E includes those long-term tangible assets that companies use in their operations, right? Things like buildings, machinery, vehicles, and land. It's the backbone of a company's physical infrastructure.
You got it. Accounting for PP&E involves determining the initial cost, allocating that cost over the asset's useful life through depreciation, and accounting for any subsequent expenditures related to the asset.
Determining the initial cost of PP&E might seem straightforward, just the purchase price, right? But I'm guessing there's more to it than that.
You're right. The initial cost includes all the costs necessary to acquire the asset and get it ready for use. This could include the purchase price, freight costs, installation costs, testing costs, and even legal fees associated with the purchase.
So it's about capturing the full cost of getting that asset up and running, not just the sticker price.
Exactly. Once the initial cost is determined, we need to allocate that cost over the asset's useful life. That's where depreciation comes in.
Depreciation is the process of spreading the cost of an asset over its useful life to reflect its gradual decline in value.
Precisely. And there are various depreciation methods, each with its own logic and implications for a company's financial statements. The straight line method is the simplest, spreading the cost evenly over the asset's useful life. Then there are accelerated depreciation methods, like the double declining balance method, which depreciate the asset more quickly in the early years of its life.
I can see how the choice of depreciation method could impact a company's reported earnings.
Absolutely. Now, one unique asset in the PP&E category is land. Land is generally considered to have an indefinite useful life, unlike buildings or equipment that wear out over time.
So land doesn't depreciate.
Exactly. It's assumed to hold its value indefinitely. However, land improvements, things like landscaping, parking lots, or fences, do depreciate because they have a limited useful life. Now, there's another interesting wrinkle when it comes to PP&E. Interest costs incurred during the construction period.
So if a company is building a new factory and they're borrowing money to finance that construction, what happens to those interest costs? Are they expensed as incurred?
Not always. Interest costs incurred during the construction period of qualifying assets can actually be capitalized. This means they're added to the cost of the asset rather than expensed immediately.
It's like treating those interest costs as part of the investment in the asset itself.
Precisely. It reflects the fact that those interest costs are directly tied to creating that asset. However, there are specific rules and criteria for interest capitalization to make sure it's applied appropriately.
Okay, that makes sense. Now, what happens when a company disposes of PP&E? Maybe they sell a piece of equipment or even retire an old building.
When PP&E is disposed of, the company removes the asset's cost and accumulated depreciation from the balance sheet and recognizes any gain or loss on the disposal.
The gain or loss is essentially the difference between the proceeds from the sale and the asset's net book value.
Exactly. Now let's move on from those tangible assets to a category that's often less visible but just as valuable: intangible assets.
Intangible assets are those assets that lack physical substance but still hold value, right? Things like patents, copyrights, trademarks, goodwill, and even software. They represent a company's intellectual property and brand value.
You got it. Accounting for intangible assets involves determining their initial cost, allocating that cost over their useful life through amortization, which is essentially depreciation for intangibles, and testing for impairment if there's evidence that the asset's value has declined. You got it. Accounting for intangible assets involves determining their initial cost, allocating that cost over their useful life through amortization, which is essentially depreciation for intangibles, and testing for impairment if there's evidence that the asset's value has declined.
So just like with depreciation, there are different methods for amortization, but the straight line method is the most common, right?
Exactly. And one unique intangible asset is goodwill. Remember, goodwill arises from acquisitions and represents the excess of the purchase price over the fair value of the identifiable net assets acquired.
It's like paying a premium for a company's reputation, customer relationships, and other intangible factors that contribute to its value.
Precisely. And because goodwill doesn't have a specific useful life like a patent or copyright, it's not amortized.
But it is tested for impairment regularly, right? To make sure it's still worth what's reflected on the balance sheet.
That's right. Impairment testing involves comparing the fair value of an asset to its carrying amount, its book value, essentially. If the fair value is lower, an impairment loss is recognized.
Okay, so even though intangible assets might not be physically visible, they're still subject to valuation adjustments and can impact a company's financial statements.
Absolutely. Now let's shift our focus from assets to the other side of the balance sheet: liabilities.
Liabilities represent a company's obligations to others. What are some common types of liabilities we might see on a balance sheet?
Liabilities are broadly categorized into current liabilities and long-term liabilities. Current liabilities are those that are expected to be settled within 1 year. Think accounts payable notes, payable salaries, and wages, payable interest payable, and taxes payable.
Accounts payable represent the amounts owed to suppliers for goods or services purchased on credit. It's like a running tab with those vendors.
Exactly. Notes payable, as we discussed before, can be either short-term or long-term, depending on when they're due.
So a short-term note payable will be classified as a current liability, while a long-term note payable would be a long-term liability.
Precisely. Now, salaries and wages payable represent the amounts owed to employees for work they've already done but haven't been paid for yet. It's like a short-term IOU to employees.
And interest payable is the interest that's accrued on outstanding debt waiting to be paid. And taxes payable are the taxes owed to various government entities.
You got it. Those are some of the common payables we see on balance sheets. But there's another category of current liabilities that's important to understand: accrued liabilities.
Accrued liabilities are expenses that have been incurred but haven't been paid yet, right?
Exactly. For instance, if a company has used utilities during a period but hasn't received the bill yet, they would accrue a liability for those utilities, recognizing the expense and the corresponding liability.
Okay, so accrued liabilities capture those expenses that belong in the current period, even if the cash hasn't been paid yet.
Precisely. Now let's delve into a more complex type of liability: contingencies.
Contingencies are those potential liabilities that depend on uncertain future events, right? It's like a maybe liability hanging over the company's head.
That's a great way to put it. Contingencies can be either loss contingencies, potential future losses, or gain contingencies, potential future gains. But the accounting treatment for those two types is very different.
Let's start with loss contingencies. What are some common examples?
Loss contingencies can arise from a variety of situations. Think of pending lawsuits, product warranties, environmental liabilities, or even guarantees of debt issued by other parties.
So if a company is being sued, they might have a loss contingency related to that lawsuit, even if they don't know yet whether they'll ultimately be found liable.
Exactly. The accounting treatment for loss contingencies depends on the likelihood of the loss actually occurring and whether the amount of the loss can be reasonably estimated.
I remember those likelihood categories.
Yeah.
Probable, reasonably possible, and remote.
You got it. If the loss is probable and can be reasonably estimated, the company would accrue a liability on their balance sheet recognizing that potential loss. If the loss is reasonably possible but not probable, it would be disclosed in the notes to the financial statements, highlighting the potential risk but not actually booking a liability. And if the loss is remote, meaning it's highly unlikely to occur, it's not even disclosed.
So the more certain and measurable the potential loss, the more formally it needs to be recognized in the financial statements.
Precisely. Now, what about those gain contingencies?
Gain contingencies represent potential future gains, right? Like winning a lawsuit or receiving a tax refund.
Exactly, but the accounting treatment for gain contingencies is much more conservative.
Meaning you can't book a gain until you're absolutely sure you're going to get it.
Exactly. It's all about avoiding premature recognition of revenue. Gain contingencies are generally not recognized in the financial statements until they're realized, meaning the gain is essentially certain.
So even if a company is highly likely to win a lawsuit, they wouldn't recognize that potential gain until the court has made its final ruling.
Exactly. It's better to err on the side of caution when it comes to potential gains. Now let's move on from contingencies to a broader category of obligations: long-term liabilities.
Long-term liabilities are those obligations that are due beyond 1 year, right? Things like loans, bonds, and leases.
You've got it. They represent a company's long-term financing commitments and can significantly impact their financial flexibility.
What are some common types of long-term liabilities we might see on a balance sheet?
Common examples include bonds, payable notes, payable mortgages, payable lease liabilities, and pension liabilities.
Let's start with bonds payable.
Uh,
Those are debt securities issued by a company to raise large amounts of capital from investors.
Right, exactly. Bonds represent a promise to repay the principal amount at a specific maturity date and to make periodic interest payments to the bondholders.
So it's like taking out a loan from a large group of investors instead of from a bank.
That's a great way to think about it. Now, notes payable, as we discussed before, can be either short-term or long-term, depending on their maturity date. Mortgages payable are long-term loans secured by real estate, typically used to finance property purchases.
And lease liabilities arise from lease agreements where a company makes payments for the use of an asset, such as equipment or office space.
Right. And pension liabilities represent a company's obligation to make future pension payments to their employees. These are based on actuarial calculations that consider factors like employee demographics, salary levels, and expected investment returns.
So accounting for long-term liabilities involves more than just recording the face value of the obligation, right? You have to consider the time value of money.
You're exactly right. Because those future payments are worth less than money received today, we need to discount those future cash flows to their present value. This involves using an appropriate discount rate to reflect the time value of money and the risk associated with those future cash flows.
Okay, so it's not just about when those payments are due, but also about the present value of those future payments.
Precisely. Now let's take a deeper dive into bonds and explore some of the unique aspects of their accounting.
I'm ready. Bonds have always seemed a bit mysterious to me, especially with those concepts like premiums and discounts.
Bonds are fascinating financial instruments. Remember, they have a face value, a maturity date, and a stated interest rate, often called the coupon rate.
The face value is the amount that will be repaid to the bondholders at maturity, and the coupon rate determines the periodic interest payments they receive.
Exactly. However, the price that investors are willing to pay for a bond in the market might not always equal its face value. This discrepancy depends on the relationship between the bond's coupon rate and the prevailing market interest rates.
So if the market interest rates are higher than a bond's coupon rate, investors would demand a discount, meaning they would pay less than the face value for the bond.
Precisely. They're essentially demanding a higher effective yield to compensate for that lower coupon rate. And conversely, if the market interest rates are lower than a bond's coupon rate, investors would be willing to pay a premium, meaning they would pay more than the face value.
It's all about aligning the bond's yield with the prevailing market conditions.
Exactly. Now, this difference between the bond's carrying amount, which reflects the present value of its future cash flows, and its face value, is either a discount or a premium. And this discount or premium needs to be amortized over the life of the bond.
Amortization in this context means gradually reducing that discount or premium over time, right?
Exactly. We use the effective interest method, which ensures that the interest expense recognized each period reflects the effective interest rate, the rate that takes into account both the coupon rate and the discount or premium.
So even though the coupon payments might be fixed, the interest expense recorded on the income statement can fluctuate as that discount or premium is amortized.
Precisely. Now, what happens if a company decides to redeem a bond before its maturity date? Maybe they want to take advantage of lower interest rates or simply reduce their debt burden.
That's called early extinguishment of debt,
You
right?
got it. When a bond is extinguished early, the company removes its carrying amount from the balance sheet and recognizes any gain or loss on the extinguishment.
That gain or loss is the difference between the price the company pays to redeem the bond and the bond's carrying amount on their books.
Exactly. And this can create some interesting accounting entries as companies manage their debt portfolios.
Okay, I'm starting to see how bond accounting can get pretty complex, but it's fascinating to see how those market forces and time value of money concepts come into play.
Absolutely. Now let's move on from bonds to another type of contractual agreement that can have a significant impact on a company's financial statements: leases.
Leases are everywhere. From cars and equipment to office space and even software, it seems like everything can be leased these days.
You're right, leases provide companies with flexibility and can help them manage their cash flow. But accounting for leases can be surprisingly complex.
Yeah, I know there are two main types of leases under U.S. GAAP: finance leases and operating leases. What's the difference, though? I mean, it seems like they both involve making payments for the use of an asset.
The key difference lies in the economic substance of the lease arrangement. Finance leases are essentially treated as purchases where the lessee, the party using the asset, assumes most of the risks and rewards of ownership. Operating leases, on the other hand, are treated more like rentals.
So with a finance lease, the lessee would record an asset and a liability on their balance sheet, just as if they had purchased the asset outright.
Exactly. The asset represents their right to use the leased asset, and the liability represents their obligation to make those lease payments. With an operating lease, however, the lessee doesn't record an asset or a liability. They simply recognize lease expense on their income statement over the lease term.
So the classification of a lease as either finance or operating can significantly impact a company's financial statements.
Absolutely. And the criteria for classifying leases can be quite detailed, but it boils down to assessing whether the lease transfers ownership of the asset contains a bargain purchase option, covers a major portion of the asset's useful life, or requires payments that essentially reflect the asset's fair value.
It sounds like lease accounting requires careful analysis of those lease agreements to determine the appropriate classification and accounting treatment.
You've got it. Now let's move from leases to a broader category that encompasses a wide range of financial assets and liabilities. Financial instruments.
Financial instruments can be pretty intimidating, especially when you start talking about derivatives and hedge accounting. Can we just break down the basics?
Of course, financial instruments are essentially contracts that create both a financial asset for one party and a financial liability or equity instrument for another party. They're the building blocks of modern finance, enabling the efficient transfer of risk and capital.
So we're talking about things like stocks, bonds, loans, and even more complex instruments like derivatives and insurance contracts.
Exactly. And one of the key challenges in accounting for financial instruments is determining the appropriate classification and measurement basis. For example, debt securities, which are essentially loans, are often classified as either trading securities available for sale securities or held-to-maturity securities.
Okay, let's break those down. Trading securities are those held for short-term trading purposes, right? They're bought and sold frequently with the goal of generating profits from price fluctuations.
Exactly. They're reported at fair value on the balance sheet, with changes in fair value recognized on the income statement each period.
So any gains or losses from those trading activities flow directly through to the company's earnings.
Precisely. Now, available for sale securities are a bit different. They don't fit the definition of trading securities or held-to-maturity securities. They're also reported at fair value, but changes in fair value are initially recognized in other comprehensive income, which is a separate component of equity, and then reclassified to the income statement when they're sold or impaired.
So it's like parking those unrealized gains or losses in a temporary holding area until they become realized.
That's a great way to put it. Now, held-to-maturity securities are debt securities that a company has the intent and ability to hold until they mature. They're reported at amortized cost on the balance sheet, which reflects the gradual reduction of any premium or discount over the life of the security.
So held-to-maturity securities are like those long-term investments
Right.
where the company is committed to holding them for the long haul, collecting those interest payments, and receiving the principal back at maturity.
Exactly. Now, what about equity securities? Those are investments in other companies, right?
Yes, equity securities represent ownership interests in other companies. They can range from small passive investments to large controlling stakes.
Exactly. And the accounting treatment for equity securities depends on the level of influence the investor has over the investee. For investments where the investor has significant influence but not control, a special method called the equity method is used.
So if a company owns between 20% and 50% of another company's stock, they would likely use the equity method.
You've got it. Significant influence is generally presumed within that ownership range, but there are other factors that can indicate influence as well.
What's unique about the equity method? How is it different from just recording the investment at cost?
Under the equity method, the investment is initially recorded at cost, but the investor's share of the investee's net income or loss is recognized on the investor's income statement each period.
It's like having a window into the investee's profitability.
Precisely. The investment account is adjusted each period to reflect the investor's share of the investee's earnings or losses and any dividends received.
So the equity method captures the economic substance of that investor-investee relationship, recognizing the investor's ongoing influence over the investee's performance.
Exactly. Now, speaking of combining the financial information of multiple entities, let's revisit consolidated financial statements. We touched upon them briefly when discussing subsidiaries, but there are some additional insights we can explore.
Consolidations are all about creating that unified financial picture when a parent company has a controlling interest in one or more subsidiaries. It's like piecing together a financial jigsaw puzzle.
You've got it. And one of the key aspects of consolidations is understanding the concept of control.
Yeah, I remember we talked about the 50% ownership threshold, but I'm guessing there's more to it than that.
You're right. Control isn't solely determined by ownership percentage. It's about having the power to direct the activities of another entity, even if that ownership is less than 50%. There might be contractual agreements or other circumstances that give a company effective control, even if their ownership stake is smaller.
So consolidations are driven by control, not just ownership percentages.
Precisely. And once we've determined which subsidiaries should be consolidated, The next step is eliminating those intercompany transactions to avoid double counting and to ensure the consolidated financials accurately reflect the economic substance of the combined entity.
It's about presenting a clear and accurate view of the entire group as if they were a single economic unit.
Exactly. Now let's shift gears and explore a business structure that's often chosen for smaller businesses or professional practices: partnerships.
Partnerships involve two or more individuals pooling their resources and expertise to run a business together. It seems like the accounting for partnerships could get pretty complex, especially when those ownership interests are constantly changing.
It definitely has its intricacies. Partnership accounting encompasses everything from the initial formation of the partnership to the admission and withdrawal of partners, and ultimately to the liquidation of the partnership.
Let's start with the formation. What happens when a partnership is first created? How are those initial contributions accounted for?
Each partner typically contributes something to the partnership: cash, property, equipment, or even their valuable expertise. Those contributions are recorded at their fair value, establishing the initial capital balance for each partner.
So those capital balances represent each partner's ownership stake in the partnership.
Exactly. And a crucial document in partnership accounting is the partnership agreement. This agreement outlines the terms of the partnership, including how profits and losses will be allocated among the partners.
So the partnership agreement is like the rule book for how the partners will interact financially.
Precisely. It might specify a fixed profit-sharing ratio, such as 50-50, or a more complex formula that takes into account factors like capital contributions, time invested in the business, or specific expertise.
Okay, so the partnership agreement sets the stage for how that financial pie will be divided. Now, what happens when a new partner wants to join the partnership?
That's called admission of a partner, and it requires adjustments to the existing partner's capital accounts to reflect the new partner's ownership interest. The new partner's ownership interest is typically negotiated among the partners and might involve a buy-in payment or a contribution of assets.
It's like welcoming a new player to the team and adjusting everyone's ownership stakes accordingly.
That's a great analogy. Now, what happens when a partner decides to leave the partnership?
That's called withdrawal of a partner. And I imagine it also involves adjusting those capital accounts and figuring out how much the departing partner should be paid.
You're right. The withdrawing partner is typically paid out their share of the partnership's assets, but the payout amount might not always equal their exact capital balance. It can depend on factors like the partnership's profitability, any unrealized gains or losses on assets, and the specific terms negotiated for the withdrawal.
It's like settling accounts with a departing team member, ensuring they receive their fair share, while also considering the impact on the remaining partners.
Exactly. And the eventual dissolution of a partnership is called liquidation. This involves selling off the partnership's assets, paying off any liabilities, and distributing any remaining cash to the partners according to their final capital balances.
So liquidation is like closing up shop and dividing the proceeds.
Precisely. Partnership accounting, with its emphasis on fairness and transparency, ensures that all partners are treated equitably throughout the life cycle of the partnership, from formation to liquidation.
Now let's switch gears and talk about one of the core financial statements, the statement of cash flows. We touched upon it briefly earlier, but it deserves a deeper dive.
The statement of cash flows is crucial for understanding a company's liquidity and financial flexibility. It provides a detailed look at where cash came from, where it went, and how the overall cash balance changed during a specific period.
Yeah, I remember it being divided into three main sections: operating activities, investing activities, and financing activities.
You've got it. Operating activities encompass the cash flows related to the company's core business operations, like cash received from customers and cash paid to suppliers and employees. Investing activities focus on the acquisition and disposal of long-term assets, such as property, plant, and equipment, and investments in other companies. And financing activities relate to how the company raises and repays capital issuing and repurchasing stock issuing and repaying debt and paying dividends to shareholders.
I also remember there being two methods for presenting operating activities on the statement of cash flows: the direct method and the indirect method.
That's right. The direct method presents the major categories of cash receipts and payments in a very straightforward way, showing the actual cash inflows and outflows from those operating activities. The indirect method, on the other hand, starts with net income from the income statement and adjusts it for non-cash items and changes in working capital accounts.
So the indirect method kind of reconciles net income with the actual cash flow from operations, considering those timing differences that arise from accrual accounting.
Precisely. And even though the direct method is generally considered more transparent, the indirect method is much more common. It's easier to prepare using the readily available information from the income statement and balance sheet.
But companies that use the indirect method still have to provide a supplemental disclosure showing the cash paid for interest and income taxes, right?
That's right. It's a way to provide some of the detail that would have been included directly under the direct method.
Okay, so the statement of cash flows, whether presented using the direct method or the indirect method, is a powerful tool for understanding a company's cash generation, its investing activities, and its financing strategies.
Absolutely. It provides a perspective that you just can't get from the other financial statements.
Now let's move on to a topic that often strikes fear into the hearts of even experienced business professionals: income taxes. I know taxes are a significant expense for most companies, and the accounting for them can get quite complex.
You're right. Income tax accounting involves not only determining the income tax payable for the current year, which we call the current tax expense, but also considering the impact of temporary differences between how income is recognized for tax purposes versus how it's recognized for financial accounting purposes.
Those temporary differences lead to what's called deferred tax liabilities or deferred tax assets, right?
Exactly. Temporary differences arise because tax rules and accounting rules don't always align perfectly. This can create timing differences in when revenue and expenses are recognized, leading to differences in taxable income versus a financial accounting income.
And those differences are called temporary because they'll eventually reverse in the future.
Precisely. For example, if a company uses accelerated depreciation for tax purposes, but straight-line depreciation for financial accounting purposes, that creates a temporary difference that will eventually reverse as the depreciation expense for tax purposes catches up to the depreciation expense for financial accounting purposes.
So those temporary differences create those deferred tax liabilities or assets.
Exactly. Deferred tax liabilities represent future tax payments that will be higher because of those temporary differences, while deferred tax assets represent future tax payments that will be lower.
And calculating those deferred tax liabilities and assets involves applying the current tax rate to those temporary differences, recognizing that tax rates can change in the future.
That's right. It's based on the enacted tax rates that are expected to be in effect when those temporary differences reverse.
Income tax accounting can be challenging, but it's crucial for accurately reflecting a company's current and future tax obligations in those financial statements.
Absolutely. Now let's shift our focus to a specialized area of accounting that's particularly relevant for organizations with a mission to serve the public good, not-for-profit financial reporting.
Yeah, not-for-profits have unique missions and financial reporting needs compared to those for-profit companies we've been discussing. They're not driven by shareholder profits. They're focused on fulfilling their specific charitable or public service goals.
You're right. Not-for-profits, also known as nonprofit organizations, play a crucial role in society, addressing a wide range of needs from providing social services and promoting the arts to advancing scientific research and advocating for environmental protection.
And their financial statements are designed to showcase how effectively they're using their resources to achieve those missions and to demonstrate accountability and transparency to their donors and the public.
Exactly. And one of the key differences in not-for-profit accounting is the concept of net assets. They don't have stockholders' equity like for-profit entities. Instead, they have net assets, which represent the residual interest in their assets after deducting liabilities.
And net assets are categorized based on the restrictions placed on their use, right?
You've got it. Not-for-profit net assets are classified as either unrestricted, temporarily restricted, or permanently restricted. Unrestricted net assets are those that have no donor-imposed stipulations on how they can be used. Temporarily restricted net assets come with limitations that will eventually expire. Think time restrictions, like having to wait a certain number of years before the funds can be used, or purpose restrictions where the funds can only be used for a specific program or project.
And permanently restricted net assets are those with limitations that last forever, like those endowment funds, where the principal must be preserved and only the investment income can be used.
Exactly. This classification of net assets is a key element of not-for-profit financial reporting, providing transparency into the availability and use of those resources.
Not-for-profits also have a statement of activities.
Right? It seems like that would be analogous to the income statement for a for-profit company.
That's right. The statement of activities shows the revenues, gains, expenses, and losses incurred by the not-for-profit. But instead of focusing on net income, it shows the changes in net assets for the period. So it's like a financial performance report, but tailored to the unique structure of a not-for-profit organization.
Precisely. And the statement of activities also includes something called reclassifications of net assets. This happens when restrictions on those temporarily or permanently restricted net assets are met.
So if a time restriction expires or a purpose restriction is fulfilled, those restricted net assets would be reclassified to unrestricted net assets, freeing them up for use.
Exactly. It's all about tracking the flow of resources and ensuring that donor restrictions are honored. Now, do not-for-profits also prepare a statement of cash flows?
That's a great question. And yes, not-for-profits do prepare a statement of cash flows, and it follows the same format as the statement of cash flows for for-profit entities with those familiar categories. Operating activities, investing activities, and financing activities.
Got it. The statement of cash flows is crucial for not-for-profits as well, helping stakeholders understand their liquidity and financial flexibility.
Okay, so not-for-profit financial reporting is a unique world with its own set of rules and statements, but it still shares some fundamental similarities with for-profit accounting.
Absolutely. Now let's shift our focus to another specialized area of accounting that's crucial for ensuring transparency and accountability in the use of public funds: governmental accounting.
Governmental accounting is all about serving the public good, but it seems like it would be quite different from the accounting we've been discussing for businesses and not-for-profit organizations.
You're right. Governmental accounting is designed to meet the information needs of users who are concerned with things like operating efficiently and effectively, inter-period equity, ensuring that current taxpayers aren't burdened with paying for services enjoyed by past generations, and budgetary compliance, making sure the government is sticking to its approved budget.
I remember hearing about fund accounting being a key aspect of governmental accounting. Can you explain that a bit further?
Of course, fund accounting is a system where the government's resources are separated into distinct funds, each with its own purpose and set of accounting rules. It's like creating mini accounting systems within the larger governmental structure.
What are some of the common types of governmental funds?
Well, the general fund is the primary operating fund of a government accounting for most of its day-to-day activities like police and fire services, parks and recreation and general administration. Then you have special revenue funds, which account for revenues that are legally restricted for specific purposes.
So if a city collects a gasoline tax that's specifically designated for road maintenance, those funds would be accounted for in a special revenue fund.
Exactly. Then you have capital projects funds, which are used to account for the acquisition and construction of major capital assets like schools, bridges, and other infrastructure projects.
And debt service funds are used to account for the repayment of long-term debt, like those bonds we talked about earlier.
You've got it. And finally, there are permanent funds, which are used to account for resources that are legally restricted to be held in perpetuity, with only the investment income being available for spending.
So if a wealthy donor gives a city a large sum of money to establish a scholarship fund for local students, that would likely be accounted for in a permanent fund.
Precisely. Each of these fund types has its own set of accounting rules and reporting requirements, ensuring that those resources are used appropriately and in accordance with any legal or donor restrictions.
Now, what about the financial statements themselves? Are they different for governmental entities compared to those for-profit companies and not-for-profits?
Governmental entities don't use the traditional balance sheet and income statement. Instead, they have a statement of net position, a statement of activities, and a statement of cash flows.
So the statement of net position is like the balance sheet showing the government's assets, liabilities, and net position.
Exactly. Net position in governmental accounting is similar to equity for for-profit entities. It represents the residual interest in the government's assets after deducting liabilities.
And the statement of activities is analogous to the income statement, showing the government's revenues, expenses, and changes in net position for a given period.
Precisely. It provides insights into the government's financial performance and how effectively they're using their resources to provide services to their constituents.
And the statement of cash flows follows the same format as the statement of cash flows for for-profit entities, with those familiar classifications for operating activities, investing activities, and financing activities.
That's right. The statement of cash flows helps stakeholders understand the government's cash management practices and its overall financial flexibility.
Governmental accounting is definitely a complex world, but it's crucial for ensuring transparency and accountability in how governments manage those precious public funds.
Absolutely. Now, before we wrap up this deep dive into financial accounting, we need to talk about one more crucial element: professional ethics.
Ethics are the bedrock of the accounting profession, right? They're what ensure public trust in financial reporting and the integrity of financial information.
You're exactly right. Accountants hold a position of great responsibility. They're entrusted with sensitive financial data, and their work has a significant impact on businesses, investors, and the public at large.
The American Institute of Certified Public Accountants, or AICPA, has a code of professional conduct that guides accountants in maintaining those high ethical standards right.
That's right. The AICPA code outlines those core principles that govern ethical behavior for accountants. It emphasizes integrity, objectivity, independence, due care, and confidentiality.
Integrity means being honest and straightforward in all professional dealings, holding yourself to the highest moral principles.
Exactly. Objectivity mandates impartiality and freedom from conflicts of interest, ensuring that accountants' judgments are unbiased and based solely on the facts and circumstances.
And independence is particularly important for auditors, right? They need to remain independent of the companies they audit to provide objective assessments of those financial statements.
Absolutely. Independence is crucial for maintaining the credibility of the audit process and ensuring public trust in the financial markets.
Due care emphasizes competence and diligence, holding accountants to a high standard of professional care in performing their services.
Exactly. And finally, confidentiality safeguards sensitive client information, ensuring that it's not disclosed to unauthorized parties.
Ethical behavior in accounting is not just about following rules. It's about making those sound judgments, acting in the public interest, and upholding the reputation of the profession.
You got it. It's about being a responsible and trustworthy steward of financial information.
Wow, we've covered an incredible amount of ground in this financial accounting deep dive. It's been fascinating to explore the intricacies of financial statements, delve into those key accounting concepts, and even touch upon specialized areas like not-for-profit and governmental accounting.
I'm glad we could provide you with those insights and tools you need to navigate the complex world of financial accounting. Remember, it's a dynamic field that's constantly evolving, but by grasping those fundamental principles and concepts, you'll be well equipped to understand and analyze financial information.
And remember, if those financial statements ever start to feel overwhelming, or if you're ever unsure about a specific accounting concept, you know where to find us. We're always here to guide you through the fascinating world of accounting.
Until next time, keep diving deeper.